In the chill of a Monday morning, Australia's largest cargo port moved like nothing had changed. Cranes, steel, sea mist. But below deck, something historic was happening. The ship's manifest didn't list a single US dollar. Every ton of iron aboard was paid for in Chinese yuan. By the time it reached Qingdao, billions had traded hands without touching the American system once. Traders called it impossible. The markets called it the future. And in Washington, no one wanted to say it out loud. Australia just chose Beijing's money. Bloomberg confirmed that the deal would cover about 90 million tons of shipments annually, roughly a third of Australia's total iron ore exports to China. The Financial Times described it as a test case for commodity de-dollarization beyond the global south, as both sides agreed that yuan settlement would be handled through the Bank of China's Sydney branch, bypassing the U.S. clearing system entirely. It marked the first time a G20 ally of the United States had allowed large-scale commodity settlement in Chinese currency without dual invoicing in dollars. For Beijing, the symbolism was larger than the sum of tonnage, an industrial democracy shifting toward its orbit through trade math, not ideology. According to IMF data, China buys more than 75% of all seaborne iron ore worldwide, and Australia supplies nearly 60% of those imports. That concentration gives Beijing immense leverage. The People's Bank of China has long argued that monetary stability begins with commodity pricing, and by November, that strategy had moved from white paper to action. UN-based contracts for iron ore futures began trading at higher volume in Singapore and Dalian, reflecting growing market acceptance of Chinese pricing power. A Macquarie analyst told Bloomberg that if 30% of iron ore trade migrated to yuan, the currency's global share in commodity settlement could triple within 2 years. Why this matters? Every yuan-denominated cargo reduces global dollar turnover. Each transaction slightly weakens Washington's ability to weaponize payment systems, and each central bank that holds yuan for trade settlement holds fewer U.S. treasuries. The consequences showed up quickly. Australia's second-largest miner, Fortescue, announced in late October that it had secured a 14 billion yuan loan, about $2 billion, from China's ICBC and Bank of China to fund its renewable hydrogen projects. Reuters noted the loan was unsecured, carried a fixed rate of 3.8%, and could be spent freely, a structure that would be unthinkable under U.S. dollar lending. The comparable cost of borrowing in dollars, benchmarked to 5-year treasuries near 4.9%, would have been at least 150 basis points higher. For Fortescue, the incentive was mathematical. For China, strategic. It created a closed circuit. Beijing provides cheap yuan credit. Australian firms spend it on Chinese equipment, and settlement cycles return the currency to Chinese banks. By mid-November, Fortescue had awarded a $400 million contract to China's XCMG for zero-emission mining trucks, Bloomberg confirmed. It was the first major Australian mining equipment order denominated in yuan. Executives privately told the Financial Times that U.S. suppliers could not match either the price or financing terms. The effect is cumulative. What the U.S. once achieved through the dollar's convenience, China now replicates through cost and proximity. Each yuan loan deepens a supply chain. Each local currency settlement replaces a link in the dollar loop. In Canberra, the shift has split the policy establishment. Australia's Reserve Bank has welcomed more multi-currency trade flexibility, while its foreign ministry has quietly warned that yuan settlement could expose exporters to political risk if tensions with Beijing flare again. But domestic pressures are powerful. China still buys roughly 1/3 of Australia's exports. When the United States imposed new tariffs on Chinese goods in September, China responded by trimming U.S. Treasury purchases to a 16-year low, $756 billion, according to U.S. Treasury data. The next week, Chinese steel mills increased spot iron ore orders from Australia by 6%, lifting benchmark prices above $120 a ton. In commodity diplomacy, money flows where demand dictates, not allegiance. Across the Pacific, Treasury Secretary Scott Bessent called the trend manageable but concerning in a closed-door briefing leaked to Bloomberg. He warned that allies adopting yuan invoicing could erode the structural bid for treasuries that underpins low U.S. funding costs. Analysts at J.P. Morgan estimated that even a 5% decline in dollar-settled trade could raise U.S. yields by 20 basis points, adding billions in annual interest expense. As one strategist put it to Reuters, if friends stop using your currency, your enemies don't have to fight you. The yuan's rise isn't limited to resources. In Singapore, the city-state's monetary authority reported that yuan trade financing surged 68% year-on-year by October, surpassing the euro for the first time in Asia. Indonesia, Thailand, and Malaysia have all signed bilateral currency swap lines with Beijing to support trade settlement. The Reserve Bank of Australia quietly renewed its own 200 billion yuan swap with the People's Bank of China in August, ensuring liquidity for local banks transacting in the currency. None of these deals are dramatic on their own. Together, they redraw the region's financial wiring. Beijing's playbook echoes Washington's old one: make your currency the lubricant of prosperity, not the instrument of ideology. Bloomberg Intelligence estimates that Chinese banks now handle 36% of cross-border settlements in Asia ex-Japan, up from 22% 2 years ago. For global corporates, transaction cost, not loyalty, dictates payment choice. When dollar funding costs exceed 5% and yuan loans sit below 4%, balance sheets vote pragmatically. Australia's pivot therefore fits a wider pattern. South Korea's export credit agency, Kexim, issued its first yuan-denominated bonds in Shanghai in September, raising 1 billion yuan to finance shipbuilding equipment. The Wall Street Journal noted that the move signals hedging behavior by U.S. allies facing dollar volatility. Japan's trade ministry also authorized yen-yuan settlement for select import categories, a quiet nod to China's growing share in Asia's supply networks. As the WTO observed in its October trade outlook, intra-Asian trade now exceeds trans-Pacific volumes by value for the first time in history. Why this matters. The global financial order tilts toward the center of manufacturing gravity. Whoever clears more trades in their currency accumulates influence without firing a shot. In response, Washington has tried to tighten alignment through tariffs and security frameworks. President Trump raised levies on Chinese steel, EVs, and critical minerals to as high as 60%, calling it strategic decoupling. But tariffs that raise input costs for allies like Australia have unintended effects. They push those allies closer to China, whose markets remain open. Canberra's exporters see the choice less as politics than arithmetic. A miner who loses a U.S. buyer gains a Chinese one. What matters is the invoice currency. The Financial Times reported that Australian LNG producers are now in talks with China National Offshore Oil Corporation about partial yuan settlement for long-term contracts. If implemented, it would mark the first non-oil energy deal in Chinese currency between the two nations. China already imports nearly half its LNG from Australia. Each new contract settled outside the dollar system strengthens the precedent for others. Meanwhile, the BRICS bloc, expanded this year to include Saudi Arabia, the UAE, Egypt, and Iran, continues to coordinate alternative payment systems. Reuters reported that the group's working committee met in Johannesburg in late October to design a shared clearing platform linking domestic payment networks. While officials denied that a single BRICS currency is imminent, they confirmed that, quote, cross-settlement in national currencies has reached operational scale. In practice, this means oil trades between Russia and India can clear in rupees or dirhams, while China and Brazil use yuan. The fragmentation of dollar channels is gradual but cumulative. For the U.S., the problem is structural. As deficits swell beyond $1.8 trillion, the Treasury must issue record volumes of debt. Foreign buyers, once reliable, are diversifying. The latest TC data show total foreign holdings of treasuries at $9.1 trillion, but the composition has shifted. China's share down, UK custodial holdings up, and private demand increasingly from hedge funds using repo leverage rather than real reserves. When real economy trade moves off the dollar grid, financial demand eventually follows. Inside the White House, advisors argue over how to respond. Some push for financial sanctions to deter yuan adoption. Others, including Besant, caution that coercion would accelerate the trend. The Wall Street Journal quoted a senior Treasury official as saying, "You can't sanction half your trade partners and expect them to keep your currency." For now, Washington relies on the depth of its capital markets to maintain dollar dominance. But depth doesn't substitute for trust. In Beijing, officials frame the shift differently. Central Bank Governor Pan Gongsheng told reporters in late October that internationalization of the renminbi is the natural result of market choice. Behind the scenes, state banks have been instructed to expand cross-border clearing capacity and encourage counterparties to invoice in yuan where efficiency allows. This language mirrors U.S. guidance from the 1980s when the Treasury promoted dollar settlement for oil contracts. History doesn't repeat, but billing terms do. Back in Perth, Australian business leaders call it realism, not rebellion. "We sell to whoever buys," one mining executive told the Financial Times. "If the buyer pays in yuan, we adapt. The rocks don't care what color the currency is." Yet the symbolism resonates globally. Within a decade, the U.S. dollar evolved from a universal intermediary to a conditional one. Every ally that hedges against Washington's volatility adds weight to the alternative. By late November, BHP's first yuan-settled shipment left Port Hedland bound for Qingdao. Payment cleared through China's cross-border interbank payment system in under 2 hours, bypassing New York's Fedwire entirely. Market analysts called it the quiet debut of a parallel rails system. On the same day, the U.S. Treasury auction struggled to cover long bond issuance, tailing by 3 basis points, an echo of waning foreign demand. The narrative that de-dollarization was a BRICS phenomenon now looks outdated. It has become an arithmetic of incentives. The yuan's share of global payments rose to 5.2% in October, according to SWIFT data, its highest on record, surpassing the yen. That may seem small, but movement at the margins defines inflection points. Currencies change hands one invoice at a time. As Asia rewires its trade architecture, Europe watches uneasily. The European Central Bank's internal memo, leaked to Bloomberg, warned that Asia's currency regionalization could reduce euro liquidity in global markets. The note acknowledged that China's Belt and Road settlements, now 35% yuan denominated, represent a competing standard for emerging market finance. In simpler terms, the network effect is migrating east. And yet, amid the shift, contradictions remain. The transformation isn't revolution, it's erosion. But erosion reshapes landscapes more permanently than shocks. When Scott Bessent briefed the president last week, he reportedly concluded with one line that didn't appear in any transcript. "We thought the risk was China dumping treasuries," he said. "The real risk is our allies never needing them again." We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.